Have you ever looked at an investment and seen a tiny fee, maybe something like 0.03%, and thought, that's nothing, who cares? Well, today I'm going to show you why that tiny percentage is one of the most important numbers you'll ever see in your investing journey. It could be the difference between retiring comfortably and working for an extra decade. So, let's break down ETF fees and why they matter so much. First off, what are we even talking about? When you invest in an ETF or an exchange-traded fund, there's a small annual fee called the expense ratio. Think of it as a management fee for the company that runs the fund. They handle all the buying and selling of stocks within the fund to track an index, like the S&P 500, and this fee covers their operational costs. It's expressed as a percentage of your total investment. So if you have $10,000 in an ETF with a 0.1% expense ratio, you're paying $10 a year. Seems small, right? Here's where it gets crazy. That fee doesn't just get paid once. It's charged every single year. And just like your investments compound and grow, these fees compound too, but in the wrong direction. It's like a tiny leak in your financial boat. At first you barely notice it, but over 20, 30, or 40 years, that tiny leak can sink your returns. This is the concept of negative compounding, where fees eat away at your growth year after year, and you lose out not just on the fee itself, but on all the future growth that money could have generated. Let's run a quick comparison to see this in action. Imagine two investors, Alex and Ben. They both invest $100,000. Alex chooses a low-cost S&P 500 ETF with a 0.03% expense ratio. Ben, on the other hand, invests in an actively managed fund with a 1% expense ratio, thinking it might perform better. Let's assume both funds earn an average of 8% per year before fees. After 30 years, Alex's investment, with that tiny 0.03% fee, will have grown to just over $970,000. Not bad at all. Now, what about Ben? His 1% fee might not sound like much, but after 30 years, his investment will be worth around $760,000. That's a difference of over $200,000. Ben paid more than $200,000 in fees and lost potential growth, all because of a seemingly small 1% difference. It's a new car, a house down payment, or a very, very long vacation, all gone to fees. So why are ETFs generally so much cheaper than other funds, especially traditional mutual funds? It comes down to their structure. Most ETFs are passively managed. This means they're designed to simply track a market index, like the S&P 500 or the Nasdaq 100. There's no team of highly paid analysts trying to pick winning stocks. It's all very automated and rules-based, which keeps costs incredibly low. In contrast, actively managed funds have portfolio managers who are constantly researching and trading, trying to beat the market. This activity, plus their salaries and bonuses, drives up the fees significantly. And here's the kicker. Study after study shows that the vast majority of these expensive, active funds fail to beat their low-cost passive counterparts over the long term. For beginners, this is the most powerful concept you can learn right now. When you're just starting out, your account balance might be small, and a 1% fee might only be a few dollars. It's tempting to ignore it. But the habits and choices you make today set the foundation for your entire financial future. By choosing low-cost funds from the very beginning, you are maximizing the power of compounding in your favor. You're ensuring that more of your money stays invested and working for you, not for a fund manager. Over a lifetime of investing, this single decision can add hundreds of thousands, if not millions, of dollars to your net worth. It's the closest thing we have to a guaranteed win in the world of investing. So next time you're choosing an investment, don't just look at past performance. Look at that expense ratio. Hunt for the lowest fees you can find for the index you want to track. Your future self will thank you for it. Thanks for watching. If this helped clear things up for you, give this video a like and subscribe for more simple tips to help you build wealth. See you in the next one.